Let's talk about a quiet force in the bond market that can cause big moves, even panic. It's called the basis trade. So what is it? In simple terms, it's when a hedge fund buys US Treasury bonds and sells Treasury futures at the same time. They're betting on a small price gap between the two, the basis, and they use leverage to amplify that tiny profit. Here's how it works. Treasury bonds and futures usually track each other closely. But sometimes, they trade at slightly different prices. A hedge fund might borrow heavily, buy $1 billion worth of bonds, and short futures contracts that mature at the same time. If that gap narrows, they close both sides and keep the difference, multiplied by leverage. Sounds safe? Not always. This trade can unwind fast in a crisis. Here's why. If bond prices fall or futures rally unexpectedly, the hedge fund faces losses on both sides. Even worse, their leverage. So small moves get magnified. Banks might demand more collateral. That's a margin call. To meet it, funds have to sell bonds fast. That dumping of treasuries can cause yields, like the 10-year, to spike suddenly. This isn't just theory. It happened in March 2020. As COVID panic hit, hedge funds unwound basis trades. Treasury prices crashed. The 10-year yield moved violently. The Fed had to step in with emergency bond buying to stabilize the market. And here's the kicker. When bond yields rise sharply today, with no clear news, no new Fed decision, no inflation shock, this kind of deleveraging might be happening again. So when you see the 10-year jump for no obvious reason, it might not be macro. It might be margin calls. Want more clear explainers like this? Like, subscribe, and drop a comment. What's one market move or strategy you'd love to see broken down next?